We're coming into a big week, first with the presidential election and then the Federal Reserve meeting kicking off on Wednesday with that all-important rate decision coming Thursday at 2 p.m. Eastern. As of this morning, the CME Fed Watch tool saying there is broad consensus that the central bank will cut rates by 25 basis points. Here to talk all things Fed and the economic impact of the upcoming election, we've got Bill Adams. He's chief economist over at Comerica Bank. And Bill, it's great to speak with you. So I'm interested in your take on that jobs report coming in very, very below estimates here. Was that the outlier, or do you think there is broader weakness here and that the Fed should be potentially cutting even more aggressively given that weakness?
Good morning. The job market was hit by big shocks in October from Hurricanes Helene and Milton, and then also the dock workers strike and the Boeing workers strike. So a lot of one-offs holding back job growth in the month. I don't think you can extrapolate a trend from the October jobs report. However, the important information for the Fed from that report came from the downward revisions to August and September, which now show that job growth prior to those shocks was at a fairly cool pace. I have it about 160,000 per month in the year through September, incorporating the benchmark revisions released in mid-August. So the Fed's going to see that and say that the economy is running a little bit below its potential. And that's, I think, why the Fed is likely to continue to cut at their decision Wednesday.
Bill, I'm curious, when you take into account the election tomorrow and the results and ultimately what that means, and putting in context, I guess, for fiscal spending and how some of those plans differ under a potential Trump administration versus a Harris administration, in terms of how the Fed or how that plays into the Fed's calculus, the fiscal spending part of that, how do you think that Powell and his team are thinking about that and the impact that that could then have on future cuts?
One thing that the Fed's good about is waiting until they have concrete information about fiscal policy before incorporating it into how they set monetary policy. I think the election outcome, the driver of fiscal policy is going to be at least as much what happens in Congress as what happens in the White House. If we have divided government, that will probably mean more of a status quo fiscal policy, a one-party sweep, more likely to see additional fiscal stimulus, which would be a reason for the Fed to slow the pace of rate cuts in 2025. So we'll probably know that by December, probably not going to know that by Wednesday.
When we saw the yield curve, I believe like south of 4%, right, there was still this question about reacceleration and the potential risk of that. Given that both candidates have talked about significant increases to fiscal spending, is that risk of reacceleration still there? And is that something that people, in particular the Fed, should still be looking at?
It's possible that the economy reaccelerates because of fiscal spending. It's possible the economy reaccelerates because the Fed's headwinds to interest rate sensitive sectors stop being a block to multifamily housing, to manufacturing, et cetera. But I think as long as inflation stays under control, I think the Fed will feel comfortable allowing the economy to grow at its potential rate. Potential is a little bit faster than its long run level right now because we've seen a lot of workforce growth in the last 2 years and because we're seeing excellent productivity growth right now. So it's possible we'll still see solid economic growth with inflation staying around where it is, where it was in September, which is, just a hair above the Fed's 2% target by the PCE index.
Bill, is there anything to worry about where the markets or where we do stand on the Fed's fight to tame inflation versus what the market is expecting? The market very optimistic about the progress that has been made. Is it a bit maybe too optimistic at this point?
It's possible we'll see another big shock to the economy. There's risks out there from obviously the war in the Mideast and in Ukraine, the U.S. election uncertainty, H5N1, another potential shock to the economy. I'm watching that. But if those shocks don't materialize, it looks like we're set up for a year of solid growth in 2025 with inflation behaving much more normally, which would be great news to see.
On the topic of inflation, I'm curious your take on any potential impact of tariffs, particularly if Trump becomes the president. We haven't exactly seen companies stockpiling on inventory ahead of that. How much of a risk could that pose to the inflation picture?
I think if we see a big increase in tariffs, that would probably translate to higher prices for U.S. consumers. I think the pattern in the first Trump administration was he made a big opening bid with U.S. trading partners about increasing tariffs, and then there was a long negotiation, and the final deal that he negotiated in the first administration was different from his opening bid. So I'm sort of in wait and see mode on this. I don't feel like we can extrapolate too much from the election cycle and election year promises right now.
And Bill, just to wrap this up, just in terms of your assessment of the economy, it looks like you are very positive just in terms of maybe what the next several months hold. In terms of that recession risk, has that totally been priced out at this point and not even something worth worrying about?
I think recession risk is around its historical average right now. Bad things happen. In 2019, I can't remember anyone saying that they thought a global pandemic would strike the next year. So if some big shock comes along, it could drive the U.S. economy into recession, but that doesn't look like where we're trending right now.
All right, Bill Adams, chief economist at Comerica Bank. Thanks so much for taking the time to join us.
Thanks for having me.